All right, Steve, stick around and let's get back to our panel for some reaction here. Let me begin with you, David, if I might. Is the market likely to like what it's just hearing?
No, it won't. I think the market will have been responding to better news and inflation this morning. But of course, the summary of economic projections, that was revised since March, not since the May meeting. So that's relative to what they thought 3 months ago. But still, I think it was reasonable to say that, of the officials in March, maybe on average they go up 25 basis points at the end of the year, not 50. So this would be a hawkish result in the summary of economic projections. And the problem is that if the Fed doesn't project a September rate cut on average, then it's much harder to implement one. So, we're of course we're just playing with small numbers here and decimal points. But overall, the market, which was reacting very well to this morning's CPI report, will be somewhat disappointed the Federal Reserve now sees only one rate cut this year.
That said, Michael, I think the market also understands that the Fed is itself kind of a lagging body. Their meeting started yesterday. We all know they're not going to get the 8:30 CPI report, go into the meeting and say, throw out everything that we did yesterday. We're going to come up with a different decision. And they wouldn't hang anything on a single data point anyway. So perhaps this gyration that we're seeing in response is saying, yes, the Fed still sounds hawkish, but that's because the data prior to the last couple of weeks was much more so than it's probably going to be now and going forward.
Yeah, I think that is true. The employment report was, quite strong overall. We're generating jobs 250,000 plus per month. The real economy now casting for Q2 is now up well over 2%. The economy is likely to grow at least 2% this year unless there's a sudden shift in the economy. There's a lot of good things going on in the economy, a lot of sectors of the economy not doing so well. But in aggregate, things are going pretty well. So my view has been, why mess with it? Things are going pretty well. Inflation is still well above target. There's a stickiness to what's left behind for the various reasons we've heard in the past. It's slow to come down. Interest rates are having a less powerful impact on that part of the inflation process. So let's just sit back and wait for inflation to get better. There's no rush, given the real economy performance, to do anything.
But can you sit back and wait, Michael, when you have a policy rate at 5.5? Now, Steve said this was interesting. They raised their long-term estimate, call it, of what the neutral rate is to 2.8%. But either way, you could say we're 2 points plus above what neutral should be for an economy. So do we need to still be that restrictive?
Well, exactly. The big question they're grappling with, is everyone's grappling with, is how tight is monetary policy? Where is the neutral rate? How fast can this economy grow medium term? We're certainly doing a lot better than we were in the pre-COVID, post-GFC world, and that would suggest that if growth can grow faster, policy rates may have to be higher for longer. We've thought all along that we're not going to see a major rate cutting cycle. We're going to see a mid-cycle adjustment of 50 to 100 basis points, and that's probably it.
Kristen, you say or you said just a moment ago that we're experiencing in the labor market maybe a cooling, not a contraction. Is what the Fed is doing and saying today consistent with that view, that the economy and the labor market may be cooling?
Looking at the statement, I don't think very, very minimal things change within the statement. But I think in the press conference, this is going to be important. What data points does Chair Powell actually talk most about? Because yes, you had non-farm payrolls come in very hot, but when you look at JOLTS, when you look at the ISM surveys, right, that we've seen a slowing within the labor backdrop there. There's even some estimates that we could see revisions to non-farm payrolls. And so I think the language and the tone that Chair Powell uses in terms of speaking about the employment backdrop, yes, it's strong, but if there's signs of cooling, this can give a little bit more insight. And I think the biggest surprise in this is really the 3 cuts down to 1. I think that is something that the market was not anticipating. Seeing 3 to 2, anticipated 3 to 1, not so much.
No, I think that's absolutely a great point.